DuPont is one of the oldest and most venerated companies in the US. Its history reaches back over 200 years, and the company has never stopped evolving. Over the years, it has been a leader in industries as diverse as chemicals, agriculture, pharmaceuticals, fragrances, and even dynamite. It also was the largest supplier of gunpowder to the US Army during the Civil War. According to my colleague Al Root, the future potential of DuPont stock has less to do with the company's storied past than its present, specifically its current CEO, Ed Breen.
Breen has been described to me as an adrenaline junkie, constantly doing deals, adding assets, breaking up companies, all in the hopes of creating shareholder value. He's probably best known for taking over Tyco shortly after the Dennis Kozlowski scandal back in the early 2000s. Figuring out exactly how investors have done is difficult, but it's safe to say that investors who have invested with Breen over the better part of 2 decades have beaten the market.
Breen first became CEO at DuPont in 2015 when he stewarded the company's merger with Dow Chemical, creating Dow DuPont. 2 years later, he would oversee the industrial giant's breakup into 3 parts: global agricultural and seed company Corteva, chemicals colossus Dow, and the new DuPont, which shifted its focus to specialty materials for things like semiconductors, electronics, transportation, and construction. Breen stepped down in 2019, and while shares of Dow and Corteva have both performed very well, seeing double-digit average annual returns since the spinoff, DuPont stock has been less robust, returning about 3% a year on average. Never one to shy away from a challenge, Breen retook the reins at the new DuPont in early 2020, with the mission of reinventing it once again, this time as what he described as a premier multi-industry company. He's since been on a tear, selling slower growth businesses like DuPont's Nutrition and Bioscience unit and the majority of its Mobility and Materials segment, and buying companies such as Rogers, a supplier to tech and transportation markets with products used in electric vehicles and 5G infrastructure.
Mr. Breen has essentially been trading slower growth businesses for faster growing businesses to try and get the PE ratio up to more of a market type multiple, 20 to 21 times estimated earnings. If he does that, that would mean good things for shareholders. If you look since the time he got back to DuPont in about February 2020, the stock is up about 40 to 45%. That's roughly 10 percentage points better than the S&P 500 over the same span.
On the negative side are factors like continuing inflation, supply chain issues, and the company's exposure to China. But Al thinks DuPont is well suited for such challenges.
RBC analyst Arun Viswanathan, despite any of the headwinds, sees DuPont stock hitting about $100 by the end of the year or over the next 12 months. If DuPont is able to achieve a market-like PE ratio, investors would be looking at $115 stock by the end of the year or over the next 12 months. Even if there's no multiple expansion from any of Breen's efforts and the company can simply grow earnings in line with what analysts expect, you're still looking at a stock that's going to be about $95 by the end of the year over the next 12 months. So in almost any scenario that doesn't include something really bad like a recession, DuPont looks like a very good bet.
Given its growth potential, the means to withstand temporary setbacks, and what many investors consider the company's greatest asset, Breen himself, DuPont may be worth another look.